Okay. Green light. Okay. Hang on, is it on? I'll just check. It is. Okay.
Good evening, everybody. Welcome back to the Library of Mistakes. I'm the keeper, Russell Napier. Just a little bit of an introduction. You won't be hearing much from me this evening. We are here in the Library of Mistakes, and I have some good news, possible good news. If you're watching this from London or Singapore, a Library of Mistakes may be coming to somewhere near you. I say something maybe, so if you'd like to donate to a Library of Mistakes, anyway, you know where we live. We are at keeper@libraryofmistakes.com. We are now running a little series of these events where very practiced and successful fund managers pass on their knowledge to the next generation. We've had two already with Max Ward and Angus Tulloch. And what you'll notice is that I'm not involved in these discussions because it's all about analysing companies and picking stocks, and this is not my forte, to put it mildly. So what we do on occasions like this is we get somebody else to get involved in that. Before I introduce him, let me just say that we also have the course that we offer is also online. So if you're watching far away and you'd like to learn a little bit more about a practical history of financial markets, you can find us at the website, at our website, libraryofmistakes.com. So tonight we have an expert on bottom-up analysis. He's a great friend of the library, a friend of mine. He is the man behind the balance sheet. For those of you who know behind the balance sheet, he also runs an excellent course on forensic accounting, and he's the man to do the questioning, not me. So my friend, Steve Clapham. Thanks, Steve.
Well, thank you. Am I on? Yeah. So I should just say, you know, like when you go to the Everyman Cinema, the guy comes and he says, "Have you switched your mobile phones to silent?" There's a few people checking. So listen, Anthony Bolton needs no introduction. And Anthony, what makes the difference between a good fund manager and an average fund manager?
Well, in my view, the thing that makes the difference is avoiding the mistakes. I think all managers get successes, but if you can avoid the disasters, avoid the mistakes, I think that is one thing that really differentiates the two. So being in the library of mistakes, I think learn from your mistakes and try, obviously, avoid making them. But that will get you, if you avoid the mistakes, I think you can get up into the top quartile.
And you've seen over a long period, you've seen a lot of really good investors. What are the characteristics of the best investors, apart from the fewer mistakes?
It's a lot about the type of the individual, the mind, and the flexibility and the being unemotional. I mean, I think it's terribly important to be unemotional, to be flexible. I think arrogant people and people who so much believe that they're always right will make bad investors, because things are constantly changing in this business. And I think it's about conviction. It's having conviction, but conviction varies over time as information comes in, as different events happen. No one can exactly predict the future, so there are always things coming, left field to knock you. But I always say that investing is as much about understanding yourself as it is about understanding the outside world.
And your book, and if you haven't read Anthony's book, you really should read it, because I reread it actually before doing this. Now, it is fantastic. But it's called Investing Against the Tide, and you say that you're sort of more comfortable swimming against the prevailing flow. Is that you seem like a very nice, easygoing guy, and you don't seem to have that sort of characteristic, because that's a characteristic of something quite cynical. What is it?
I don't know what it is. Yeah, I don't know what it is. I mean, people have asked me, well, does that the same in other things you do in life? And I don't think it necessarily is. But I've always been so interested in the stock market, as Buffett said, the voting and the weighing. And it's the voting side that particularly interested me, and sentiment. And fairly early on, there was the big fund in those days was the M&G Recovery Fund, and it was a contrarian fund. And when I was learning the business, I read up about it, and I just identified so much with what it was doing and sort of being contrarian. And I think talking about, my personality work or my makeup was good for being a contrarian. I was happy, I think most people like fashion, and they like to be part of the fashion. And I was happy to stand aside. And popularity, to me, is risk in investment. When things become too popular, that's when they become risky, and vice versa. When they're not popular and when they're unpopular, there's opportunity. It doesn't mean everything that's unpopular is going to be a good investment, but I like to look in the unpopular areas, and as soon as something got very popular, I became uncomfortable.
And so what happened internally at Fidelity? Because when everybody else was buying the stocks that you owned and you started to sell, were they not all going, oh, hang on, Anthony's selling, we better rush out the door as well?
No, funny, at least I don't think it happened like that. Because within Fidelity we had, a range of different managers. I mean, we had a great growth manager, Colin Stone, who's retired like me. But, we had a spectrum of approaches. But, I mean, everyone was, for all of us, it was fundamentally based, and meeting the companies was terribly important. I remember a colleague, he would go through every line, of the analyst model, line by line, cross-examining them on every assumption behind every variable. I'm not saying that's wrong. That just wasn't what I focused on. I would focus on different things from that, and I'd let my colleagues sort of spend more time on dissecting the analysts' models.
And you spent a lot of time meeting companies.
Yeah.
Did you have a sort of set structure for a company meeting? Just run us through.
Oh yeah, I mean the way we operated, and it wasn't the case in my very early days, but once we had a team of analysts and sector-based analysts, the analyst would set the agenda for the meetings, and now that didn't preclude some of the portfolio managers asking their own questions. It was great because, I was doing 4 or 5 a day, and if someone had already got the question sheet, and it was always our questions rather than letting the management say, just read off a script or a presentation. And consistency was really important to me. I kept copious notes, and it was all handwritten in those days. And consistency was really important to me. If something 3 months later was different from what it was 3 months ago, if they said it, then I started to worry. The good thing probably, and there's some management here, so the management probably were doing lots of meetings, so they probably couldn't remember exactly what they said to Fidelity versus what they said to another investor. But I had it written down.
So the moral for the management here is to say the same thing, keep your story consistent.
Even if it's wrong, say the same thing. Yeah.
But were there particular signs that you look for in a management meeting? So what would make you go out and sell? What would somebody say?
What would make, let's start with what would make me buy. It was amalgam of things, but you sort of knew it when you saw it. That was the thing. And, there were some meetings you came out of and the adrenaline was buzzing. This looked amazing and it's unrecognized, and other people don't understand the potential or whatever it was. In terms of, why did I sell things? Because the thesis was broken. So nearly always was the thesis behind why we own something. And something changes, Could be something predictable, it could be something unpredictable. And that was what made me change. Just trying to think of specifics. But for me, it was generally incremental. So I didn't one day come in and buy a huge position, or the next day, sell all my holding. Very, very occasionally I did that when something really dramatic happened. It was incremental. My conviction was building, so I'd start with a small position, and then we'd meet again, and then I'd perhaps double that position, and then as the conviction went up, or maybe the stock price came back and I felt the valuation opportunity was even greater. And it was the same on exiting. Nearly always, I'd say, well, actually, it now looks much more fairly valued. I still think there's some upside, but I'm going to, keep half the position that I had. Or it's got more risky. They're doing something which could be great news, but actually, if it doesn't work out, the downside's greater. So I want to have a smaller bet than I had. And
laterally, you had a very big fund and 150 plus positions. Yeah. How did you manage to? It just seems like a huge number.
Coping with size was obviously a big challenge, and we weren't analytical enough in those days to think about capacity. Managers are much more professional these days and saying, what is the capacity for this particular approach or this particular portfolio manager? And there was a sort of feeling, you know, you could go on forever with a fund that grew and grew and grew. I remember, actually, I had a particular advantage. I went to one of my trips to Boston, and I saw Peter Lynch and Bruce Johnson, less known Fidelity manager, but he ran our income funds very successfully. And I said, you know, how do you cope with size? And they said, well, you know, use the team to help you monitor. But the most important thing is you know, it's a balance always as an investment manager of looking after what you already own and being on top as things change, but scouting for new ideas. And they said the big mistake, as soon as you start to have a big portfolio, a large portfolio, a lot of holdings, is you're spending all your time on monitoring what you already own, and you feel if you own it and it comes into the office, then you've got to go to that meeting. They said, well, use the analyst to help you and feedback. You can't go to all these meetings, but make sure you're always spending enough time scouting for new ideas.
Well, that's interesting, because watching what you own is what everybody says. What was Peter Lynch like to work with? Did you work quite closely with him? I mean, obviously in different sides of the Atlantic.
Yeah, he taught me a lot about, you know, company meetings and taking notes, etc. He was, you know, if you read his books, you can talk about how he went about investing. But he was, an inspiring person, very demanding with the analysts, I would say, but an inspiring person to work with. And it was interesting, completely different to myself. When I stopped, I stopped and left time in my life to do other things. I remember going to see Peter, this is still a while back, but he had already, you know, stopped running funds at Fidelity, and he was in an office somewhere else in Boston. But I went into his office, and it was exactly the same as when the office that I went in, you know, surrounded by screens, reports, and everything. So he was still spending most of his day doing the same job, but this time just for himself rather than for Magellan.
Because he didn't, that was his life. He was so focused on it.
Yeah, so he loved it. And, you know, I admire that I got to a stage in my life where I wanted to sort of create some time for some other things.
It is a very all-consuming thing.
Oh, it is all-consuming, and normally when I meet people who've been in the business and then say, you know, they retire or whatever, and they're doing it part-time, they say, having done it full-time, it's very difficult to do it part-time.
And what made, because as soon as you stopped, you started writing the book.
Yeah.
What made you write the book?
I wanted to pass on some of the things I'd learned. The thing is investment, none of us do anything new. You know, most of the things we look at, etc., have been around for a long time. But it's more the amalgam of, you know, how we put it together, what weight we put on this factor versus that factor. And I wanted to sort of write a book from a contrarian investor's point of view with the things that were important for me. And, you know, there are some things there, you know, some managers would say, you know, looking at charts, technical analysis is a complete waste of time. I actually found it useful as a sort of confirming. It helped me identify changes and stuff. So I thought if I pass that on, hopefully it might help some other people.
But I mean, it's a very unpopular thing to say. I mean, I always think, you know, somebody gives you an idea, the first thing you do is look at the chart, right?
Yeah. Well, it's the first thing I always looked at, because my first question is, am I early or late, you know? And the chart immediately told me, you know, the answer to that.
But you didn't spend all your time buying things that had fallen a long way. You would buy things with momentum in them.
And actually, you know, some of the best investments was actually doubling up on something that had already started to rise, where one's conviction had increased. And 100% believe in the view just, forgetting the price you pay is so important. You've just got to come afresh every day to it.
Well, you said in the book that you didn't have a very good memory.
I didn't have a very good memory anyway, so I had to remind myself, and actually that's where the notes were really useful, rereading the notes. And even today, when I have I still do some meetings to do with our charity and stuff, I don't like to read the notes too early, because I've probably forgotten by the time the meeting happens the detail of it.
But do you think that was an advantage, not having that sort of, I paid this for it?
I think it was with me. On the other hand, one of the most successful Fidelity managers was someone called Joel Tillinghurst, who had a contrarian style, and he had a photographic memory. And, he had, hundreds of stocks in his portfolio, but if you asked him about any one of them, he could reel off, the detail. He knew everything. I couldn't do that. I mean, I can't remember or keep in my mind the detail, of 300 companies.
You've got to be a bit on the scale to do that. I think.
So it worked for me, but I'm not saying that, that means that it will work for everyone. Yeah.
And are you still in touch with people that you used to work with at Fidelity, like in states like Hurst? And
Yeah. No, I mean, more on this side of the Atlantic, because as the Fidelity got bigger, the non-US side of Fidelity was always separate from the US side. Or in fact, I think it was after I joined Fidelity, about 6 months later, we split into two. But for a long time, we had a close relationship with the managers there. But then a bit like I think Capital has done, we took the decision that to give us more capacity for buying bigger stakes in company, we needed to put a Chinese wall between the American side and the international side. And so we only saw their research with a sort of 90-day lag.
Oh, really?
Yeah.
And you said earlier, you talked about arrogance, and you wrote in the book that we're all overconfident, you mustn't let a good run go to your head. How did you manage to keep your feet in the ground after sort of 25 years of success? How did you not get caught by that?
Because you were always being reminded how fallible you were. I mean, this game, you just keep making mistakes. Coming back to the mistakes. But if you get it right 55% of the time, you're doing okay. I think it comes back to the nature of the person. I believe strongly. To be a successful investor, you shouldn't let success get to your head. But conversely, you shouldn't let failure get to your head. Everyone has a bad period. I've seen it in colleagues that when they're going through a bad period, it's they lose their confidence, etc., and they go into a sort of spiral.
You stop taking risk.
Yeah, and that's really bad as well. So
what did you say to somebody when they were having a?
I think you've got to say, look, learn from your mistakes, but remember that we all make them. And if you believe in how you invest, then stick with that, and you will have bad years. And at least the way we ran money, which was generally taking 1 to 2 year view type timescales. So we were never really short term in looking just at the next earnings.
But you had periods where you underperformed.
Oh yeah.
And what did your colleagues say to you?
I think the only time I ever talked to Ned Johnson about my performance was, I think my worst period was the recession of the early 90s. Was it 89, 90, 91? I had 3 poor years, which for most people probably was the end of their career. And I think the only time Ned Johnson talked to me specifically about my performance in investments was after those 3 years.
What did he say?
He said, you know, is it going to turn around? And I said, well, I got to do my best. And it did turn around, yeah.
But of course, there's nothing you can do.
There's nothing. It's a strange business. You know, I think a lot of new people come into it and they think it's about effort. You know, it's like sports or you know, even for a musician, effort comes into it. Well, there's an element of effort, but you can't say to yourself, you know, try harder tomorrow, Bolton, and you're going to do better. You just have to keep on re-examining what you're doing and be honest with yourself, because, and I think that's where this sort of insecurity, conviction, having conviction but always willing to be open to the fact that you're wrong is important, because things change.
And when you were underperforming, did you reduce the turnover in the portfolio or increase the turnover in the portfolio?
It's a good question. I don't remember specifically doing either of those. What I did find, it was probably in the good times you tended to build up the number of holdings. In the less good times, it was a good time for pruning, you know, going back to the things you felt the strongest about and maybe pruning out some things that were less keen on. I did the same in bull and bear markets. In bull markets, you tend to, you know, to have more stocks and more things you're interested in. In a bear market, that was a time I found for weeding out the less good things.
And so you would have a more concentrated portfolio in a bear market, and that was because you were becoming more defensive, or? No,
it was trying to focus on where you had the biggest conviction.
But why should that be different in a bear?
I don't know. I just found in the bull market there tended to be more good stories, you know, more interesting things, and therefore my number of holdings tended to blossom.
This is FOMO.
Pardon?
This was FOMO, fear of missing out.
Yeah, maybe it's the fear of missing. No, I think the nature of bull markets is that there are more good stories around, more interesting things to invest in. Yeah.
That's interesting.
Yeah.
You said in the book you value two attributes most highly: common sense and temperament. We're all stuck with with our genetics. What can you do to improve those?
Well, I think the first thing is to know yourself, know what your strengths and weaknesses are. And I think if you know that you're emotional, you've got to try and control that. To be honest, I think there's some people who are just not made out for the job. So if your personality, if you are very emotional, you know, you can only buy something after everyone else has bought it and you're near the top and you're going to be shaken out because you're scared and you don't have enough conviction in what you're doing, then I don't think it's a job for you, at least not as a sort of bottom-up stock picker.
And would you get involved in recruitment or in deciding which of the analysts were going to be PMs? And how did you judge that?
Well, you could see it. I mean, in the recruitment, one of the things we used to do was what we call a prospectus test. And we would give someone who came in a company to look at, and we'd put them in a room for a couple of hours or so with a whole lot of information on that company. And then we'd come and say, come and present to us and tell us if you think it's a buy or a sell. And it's a very good exercise because we weren't looking at, you know, was the conclusion right or wrong, but you really understood how they thought. Could they read stuff and summarize it? Could they find the most important things? Because investment is so much often about finding 3 or 4 really important things and knowing what not to look at or not to be interested in is important. And then, of course, could they convey it? Because an analyst who's brilliant but can't convey what they like and what they don't like is also no good. In terms of promotion to a fund manager, I really think the thing in this business, someone can get by with luck for 2 or 3 years. I think beyond 3 years, it's very difficult to get by purely from luck. So if you worked, as we typically had with analysts, for 5, 6, 7 years or so, before they normally had the prospect to become a fund manager, you got a pretty good idea if you thought they could make it, although just being a good analyst didn't necessarily mean you could be a good fund manager. So we'd then help them. We had something we called PM Academy, where we helped them with things like portfolio construction and stuff that they didn't need to do as an analyst.
And how about the emotional side? Could you train somebody to?
I think you could sort of see that along the way, and if you didn't think they had the temperament for it, then you had to be honest with them.
And if you were an analyst at Fidelity, how would you attract Anthony Bolton's attention? What was the thing that made you jump on a stock?
I think that the first thing is, as I was saying, we had fund managers doing different things. Income funds had different requirements. So they had to know the type of thing that I might be interested in. So they knew if they were coming to sell me, an all-market growth stock that had done really well for several years, that probably wasn't going to be for me. I think that, they had to be put across succinctly why they were keen on it. And then there were probably certain things that I would latch on that would interest me. I always, before I decided to buy things, a whole lot of stuff that I'd look at, fundamental stuff, but, I want to look at, one of the things I've always been keen on is looking at the shareholder list, because it told me who were the other, if I was early or not. If I saw other investors that I rated on the list, that was a positive in some ways, but if there were lots of them, I knew I was coming to this late. And that may be not a reason for not doing it, but I always had that at the back of my mind. Looking at, director dealing was something I used a lot as a sort of confirming or conflicting. But this whole amalgam of stuff was what I looked at, yeah.
And were there any, you might not want to say, were there any people in particular that you followed? That you...
I think it's difficult for me to say, but I think there were perhaps the opposite, in those days, that certain fund managers owned by large banks, or some of the large insurance companies. Things have changed, but, some of them I wouldn't rate that much if I saw them on the list.
It's funny because I've written about this, and it seems to me it's like the only free lunch in investing. You've got a shareholder register, and if you look and see who's on it, it can be a huge benefit, particularly for private investors.
Well, I totally agree, and you see how they move their holdings if they're above a certain percentage in the company. I think that is really useful information, and it's interesting. I found not many other people did look at share register. Another thing which is sort of connected that I think is important, it's a slightly different topic, but it links. When people compare valuations on markets, I think there are two things they miss. The one thing is the mixture of sectors. So people will say this market looks cheap against that market, but what they then don't look at is the sector dispersion. And so often that is really important in the relevant. So I much rather looked sector by sector at valuations across markets, because I think that's more meaningful. But there was a more subtle thing. There are markets that have most companies that are controlled and markets that don't. So most of the European markets, when I was dealing continental European markets, the companies are generally controlled. UK, contrastingly, most of the companies are not controlled. To me, that's a big plus, actually, for the UK. And I think the UK, everything else being equal, deserves a premium, for these are companies that can be taken over. While if you've got a controlling shareholder, they can't be taken over if the shares become too cheap. So somewhere like Hong Kong, where there were some really cheap shares, some of the cheapest shares I've ever come across, there were property companies selling at 5% of their NAV, for instance, but they were controlled. And if the controlling shareholder wasn't interested in the share price, then it didn't really matter.
Well, the people in the UK are a bit depressed by I don't know if there are any UK fund managers in the audience, but we'll see the people who are very upset. But I saw Andy Brough last night.
Oh, yeah.
He says, I'm single-handedly liquidating the UK stock market. Felt that he's had a few bids. Just going back to the analysts, I mean, how would you sort of quickly assess whether the idea was good, and what questions would you ask analysts?
Did they have a convincing thesis? So there had to be a thesis behind it, and a logical thesis. Probably I'd been in the meeting with a company that they had, so probably some of the most worthwhile discussions I had with the analysts was immediately after the company meeting. And actually, a disadvantage of doing too many meetings a day, one was rushing from one to the other, and you didn't have the quarter of an hour after the meeting where you discussed, what had changed and what was different and was the thesis still intact. Hyperbole didn't sell it to me. I mean, there were some analysts who would come to me and they'd put ridiculous price targets. My price target's 3 times the current price, and they thought that was a way of selling it to me, and it did the opposite, actually. It just made me think, that they don't have a concept of what the real upside is or not. So it had to be true to me, if you see what I mean. I had to be true. And really important was they were telling me what they thought, not what they thought I wanted to hear. And that, particularly the younger, less experienced analysts would, they'd want their idea to be bought by Bolton, so they'd come along trying to pitch it along the line. They thought that was what I wanted to know. And if I saw through that, I'd say, look, this is to your disadvantage. I want to know what you think. I will add on top of that. And the whole Fidelity way of doing things was to have these analysts who were the specialists, who knew the industry knowledge, who were normally less experienced in the sense they'd been in the industry less time. And then you got promoted on, if you made it as an analyst, and the PMs thought you had it in with you to become a portfolio manager. When you became, you were a generalist. And so for the stock to end up in a portfolio, the analyst needed to be convinced, and the portfolio manager, so the specialist and the generalist. And I think that's a very powerful combination if both are convinced. And, there were stocks in the portfolio that the analyst had a different view from me, but most of the time we have the same views.
Oh, really? So
yeah.
And you mentioned earlier that you wouldn't be interested in a growth stock that had already gone up a lot and been consistent for years. Were there particular sectors of the market that you favoured? I know you did a lot in the transport sector. I suppose I had more
very capital-intensive sectors, generally, I wasn't so keen on. The airlines, for instance, generally, so I missed things like Ryanair and EasyJet, etc.
But you made a lot of money in shipping.
But in shipping, yes, but that was sort of spotting the cycle and, buying tankers when they were near their breakup value. I mean, upside, downside is really important to me, and, balance sheet analysis, etc., which is obviously your forte. And asymmetrical return, something that didn't have too much downside but might have a lot of upside, that's what really turned me on in investment terms. So I was always looking for that, and therefore, stocks that I could sleep well at night. So spotting the anomaly is easier than knowing when it's going to work. So I needed to have time on my side, and that's why I like this sort of asymmetry of return. Now, the upside didn't always happen, and maybe you were hoping certain things, would work out, and they didn't. But if you protected the downside, and come right back to my first point, avoiding the losers is so important. I still managed to have lots of losers, but
do you know what your hit rate was?
Pardon? My hit rate? I don't actually, because we didn't measure it in those days.
And if you'd known, would it have made any difference?
Probably not. I wasn't somebody. This is interesting. This is probably very untypical these days. I didn't look at my weekly performance. I didn't. I think it only sort of depresses you. I didn't. When you're not doing well, and so I didn't look at a lot of the things that nowadays people do. I knew, I had high tracking error and all these things, but it wasn't something that was built into the way that I ran money. Probably wrongly, actually. Probably it might have helped me, if I had more access to those things.
You didn't need a lot of help, to be fair.
Well, yeah.
But you were running a retail fund.
Yes.
And so there must have been inflows and outflows, and you must have had the marketing department. Was there a lot of internal pressure?
Internal pressure in respect
Well,
of...
if you're doing badly and there's outflows, I mean,
yeah,
it's quite a geared business, right?
There was always pressure. And I made a decision when the fund got so big that I thought it was to the detriment of the performance. I made a decision that Fidelity went along with was to split the fund. This is the Fidelity Special Situations Fund, the one I ran for 28 years, was to split it into two, into a global special situations and a UK special situations. And that was very controversial, and business-wise, it was a very bad decision, actually, because it immediately led to people selling who they didn't want to have both parts of it. But I felt at the time that was the right thing to do, for investors, because I felt that was me saying, capacity is a problem and the fund is now. It was, at one stage, I think it was 5 times bigger than the nearest fund or something. It was, and that's just really difficult.
But the problem then was that the investor didn't know who was going to run the global part. Was that not the issue?
Well, no. I mean, I was part of the process who picked who was going to run it, and we announced it all. The other thing we did, we announced it quite long in advance, which I felt was the right thing to do. From a business point of view, actually, it's totally the wrong thing to do. It'd be much better, and even like announcing when I was going to retire, it would have been much better for me to say 1 week, I'm retiring next week. Because if you give, people 6 months, 9 months, a year, pre-announce your retirement, it gives the competition huge potential to say, and don't buy Anthony's fund, you don't know what the new manager's going to be like,
So
by
why
our
did
fund.
why did you tell people?
I felt it was the right thing to do.
So you always it was always integrity before profit.
With me, that was important. I felt to leave people in the lurch just wasn't something I felt comfortable with. Yeah.
I was watching the Roger Federer documentary and the plane, and just coming back last week, and he was talking about Rod Laver being a brilliant tennis player but not having made any money. And I was just wondering if you had, because of course he's made a huge amount of money.
Yeah.
I just wondered if you felt that the money being paid today had just got a bit out of hand. Because, the pod shops are paying $10 million upfront bonuses, guarantees, and I am available if there are any pod shops.
What would I talk about this? I did well enough for myself and my family. I remember, people tried to poach me. I remember Soros trying to pinch me at one stage and, promised me the earth. And I think he left the meeting. It was a lunch, and I think he left at the end. He said, "You Brits, you're not interested enough in money." Something along those lines. And, yeah, obviously the money is important. But you're asking me, is the money too big or too small? It was like, I can't tell you. It was, we were always being asked, do you think this management team is being paid too much or too little? And my view of it may be different actually from some of my colleagues, was that it's not our job to say what is too much. What I was interested was the shape of pay. That, pay, I didn't want to pay for failure, paying for success, but mandating that X is too much for a CEO, I just felt really uncomfortable.
But there is an issue here, because if the pod shops are paying up, then Fidelity has to compete with that.
Oh yeah, no. So I'm not saying money isn't important, and relative money is really important. And look, I think if a manager if money is the most important thing to them, then they're going to be a difficult person to keep. But I think there are other things that places like Fidelity offer very important.
Well, like what sort of thing?
Well, is working with a group of people that you enjoy working with. And I'm not saying the money is bad at Fidelity.
No.
Yeah, but I mean,
of course it's not. No, I just think it's an interesting issue, because, of course,
yes.
if the rewards get very skewed,
yeah.
then you suck the talent, the best.
And it was, yeah. And again, I saw it in the corporate world. That so much of the good management was going off to private equity, and I thought that was very poor. That was not good news for us who invested in listed companies, and that's what that was also a reason that I didn't want to jump on the bandwagon of saying, this CEO's salary is too high, because the alternative is they'd leave the listed sector.
You had some great stories in the book about some of the company visits. Do you remember any of them? I like the one about the Spanish CEO with the bodyguards.
Torres Ostench, yes. There was a Spanish conglomerate. Do you want me to tell the story?
Tell the story. It's a lovely story.
It was a sort of go-go conglomerate, and we went to visit it, and I think in Barcelona, I can't remember, and we had this meeting with the chief executive, and it was one of those meetings. He had a phone sort of under his desk, and every 5 minutes it rang, and he would stop the conversation, and he'd talk away, and they put it down, and that I didn't particularly like. But when it came to lunch, he said, oh, well, you know, I'm taking you for lunch. And that was great. So we thought we'd have more time to talk about the business. And it was on a big square. Well, I say a big square. It was actually not that big a square, but where sort of 4 roads intersected each other. And outside the front, I should have said, when we went into the office, the first thing we saw was a guard, an armed guard on the door, which slightly worried me. Anyway, he took us to lunch. We got into his car, and I thought, well, we're going to drive, you know, a mile or so down the road. Well, we drove to the other side of the square and got out to the restaurant. And that, I just thought, well, anyone who can't walk across the square feels that he needs to be protected. And actually, it ended up as one of the biggest bankruptcies, you know, corporate bankruptcies in Spain at that time. Anyway.
I know there's loads of people here who've got loads of questions. Who wants to ask the first question?
Thank you. I don't know if you have any children, and apologies if you don't, but I was curious as to what investment advice you gave them when they started out in adult life.
The analysts.
No, your children.
My children, sorry, I missed the most important part. It's been sad to me, none of my children have been interested in coming into the investment business. I've got a daughter and 2 sons. My 2 sons, the elder son in particular, is quite entrepreneurial, and so I've tried to help him with his business. And I was talking to someone else here about sons and entrepreneurial tendencies, and it's been mixed, to be honest. He's had some things that have gone okay and some things that haven't. But, you know, the general advice on life, I mean, to give it your all, I think, and is to try. Even if you fail, to try. I think in life, if you don't have a go, you'll always regret it. People say, why did I go and run a China fund? And it was something when I started going to China and seeing what was happening there, I got really excited about it. And I don't regret it, but I think if I hadn't done it, I would have always been sitting there thinking, you know, why didn't I give it a go? Sorry, that's probably not enough specific advice. Yeah.
Hello. Thank you for your talk. Could you touch a bit on how you managed the overall risk of the portfolio? So did you have like a threshold of risk contribution from the single names, or what have you? You didn't look at it at all. How would that work?
Yeah, no. So this, I was sort of a bit before the sort of risk analysis that we have today. Risk to me was much more, particularly about balance sheets, which I mentioned, because that nearly always, when something went wrong and I lost a lot of money, it had a weak balance sheet. And it's the sort of thing you sort of shoot yourself after. You know, each time you say, why do I keep doing this? And anyway, after a bit, you try and do it as little as you can. People, you know, the other dangerous thing, and particularly when you get into the emerging markets, well, the only one I know is China in detail, is investing with people who you don't trust, you know, who don't have integrity. That is really important in terms of risk. Then there are the sort of hidden, yes, I think where it helps, where you take unintended risks, there is some commonality that, you know, all the stocks benefit from a particular currency moving up or down, and you haven't realized how much of that's important. So to try and, you know, unless you particularly wanted to take a big view on the dollar or whatever it was, not have an unintended bet, I think that was important to me. Some knowledge of the industries and, you know, more risky industry. I mentioned capital intensity as something I didn't like. Cash flow, free cash flow was something that really appeared to me. But it was more those sort of things than some of the very sort of risk-orientated stuff, you know. And the knowledge that companies change, but often people don't change. I think one of the things I say in the book, you know, with management, I remember always with Maxwell, he came back in a different guise and he said, I've learnt my lesson and I'm now going to, you know, be a good boy and do everything right. People generally don't change, so learn that. So that's a way of avoiding risks. But another thing I say on management, it's interesting. I remember there was a company that we held. It was an oil exploration company. And we knew there was a bit of controversy about the management. But anyway, we believed in, we thought the story and what they were doing. And I tell you something that's really good. Always try and hear the other side of the story. So I found a fund that was short of the stock, and I met with the manager to hear their side of the story. And he only got through about 10 minutes of telling me why I was wrong and he was right. And I realized that he was 100% right and I was wrong. And I think that's really, so perhaps a different thing. I think it's really important to know the counter thesis of a stock that you own and to be able to address why you think that is wrong.
Thank you very much for your time tonight and sharing all your experiences. I was just wondering, looking back, is there any types of investments where you made the choice that you look back and think had a certain edge to it that came up more often than not that made it a successful investment? And I don't know if it might be a strong balance sheet like you mentioned there or management. And also just obviously we're here at Library Mistakes. Are there any kind of common mistakes you think most people make in investing that to avoid? Thank you.
So, sorry, other things in terms of mistakes, you're saying?
Yeah, common mistakes that are made. Common mistakes you think that are made by people when they make an investment.
What are common mistakes that other people make?
Yeah, and also, is there any kind of edges that you think certain investments had which were more successful than others that you look back on that came up quite a lot?
Gosh, I think it's really important to know, as I was saying, about popularity being risk. So sorry, I didn't mention it in terms of risk. When things are very popular and they're very over-owned, that is risk. I think you just need to be aware of it. And I'm not saying you shouldn't invest in those sort of situations, but you should be aware of the risk that you're taking in those situations. What other people make? This is slightly different. I think one mistake people make in general, they're always talking about the outlook. And this is often with markets. They say, well, the outlook is good or the outlook is bad. You see it at the moment. The outlook is good for America. The outlook is bad for China. That's not what this industry is about. What we're about is what view of the future is discounted in prices today. So it's about, yeah, of course it is about the outlook in the long run, but more important is what outlook is discounted in prices. So, and when I come to a company, the same thing. It's about the outlook, but what outlook is already discounted in the valuation of that stock today, and I think that's really important.
If you were starting your career today, would it be in UK listed equities?
Yes. Yeah, I mean, this is one of the great opportunities. And, yeah, you know, I'd want to be more global than I was because we're in a global world. And, you know, I was lucky to extend into the rest of Europe fairly early in my career, and that was fascinating. And then I had this sort of last chapter in 4 years in Hong Kong running China, which was fascinating, which was really interesting. People always want about, you know, they want the opportunity and they want the catalyst. But occasionally you get that, you see a really good opportunity and you see a very clear catalyst to make it happen. But in in my experience, if there's a clear catalyst, there isn't the opportunity because the stock has already moved to anticipate it. So I think catalysts, I always rather have a portfolio, a spread of things that I thought were really cheap and really undervalued, not knowing always what the catalyst was going to be. And that's what I felt most comfortable owning. Maybe it comes back to my nature. Something about my nature that I was attracted to those. And my experience was that if you were patient, that they worked, whether it was corporate activity, as we're seeing more in the UK. So, but I think behind you, you know, there are probably two questions. I think I would be more, if I was started in the business today, I think I wouldn't want to just focus so much on one market. On the other hand, I do think there's a specific opportunity in the UK today.
And can I mean,
yeah.
would you want to do equities with 50% passive? Would you not want to do VC or?
No, because VC is all about, VC is just the weighing machine. Equities is the weighing and the voting. And it's the combination of the two that I think makes it such a fascinating business. There's nothing wrong with private equity. I mean, that's interesting. But I think equities is even more interesting. And I certainly wouldn't want to do bonds. But I think equities are just so interesting. And the other thing is it puts you at the vanguard of all the most interesting developments in the world, corporate developments in the world. You see them early. And you meet some of the most interesting people in terms of the people managing the companies. So no, I still think it's the most extraordinary job.
Yeah, so I'm just very curious to hear about, I think we spoke then just now about the rise of index investing. Also then we touched on pod shops in the talk. So when the appetite for allocators is probably lower now for equity investors who are having consistent drawdowns, how do you then adapt a contrarian approach around that, and how the industry's evolved?
Yeah, I mean, the trouble with the contrarian approach is that it seems to me the momentum periods are longer these days. And that is partly due to the advent of passive funds, index funds. And it means, you know, you get these periods as we've just been in when value is done really poorly. And I was reading, I think, you know, that I think the statistic was that the 20% cheapest stocks in the world are cheaper today than any time, on a relative basis, any time than they've been, I think it was the last 30 years or something of that. I think that's really interesting, and that is where I put my money and want to have my money. But you know, there's going to be a day of reckoning because you know, 67, US is 67% of the world. So people who are investing globally, they're putting 67% of their money into the US. And a big chunk of that is into technology. All the stuff about the US market, and you know, I'm not as on top of things as I used to be, but all the stuff I look at suggests, you know, this is very near a top. And that's going to drag down all the passive funds with it when that bursts. And it's going to be a difficult time. It's going to be very good for the active investors, in my view, in that environment. But, you know, to me, all the red lights are flashing on somewhere generally like the US. Now, within the US is such a big market, there are areas that will buck the trend. But that's what I think.
Anthony, a question from me. Top down, macro, I used to go into Fidelity. You would occasionally turn up for the meetings. I've no idea why you used to turn up for the meetings. So did you have some view on macro conditions?
I didn't. I never like to have a macro view of the world dictate the whole portfolio. And I thought that was, you know, to have one view of the world. On the other hand, not to have some views, I felt was, you know, I had to, and I like to listen to a spectrum of views out there. And it would influence things at the margin. So I wouldn't want to put a big bet on my macro view, but it might make me, if I had two things that otherwise were equally attractive, and one fitted more into what I thought my macro view was, then I'd probably buy that one rather than the other one, if you see what I mean. So it was in that amalgam of stuff that I was considering, but it wasn't, to me, the be-all and end-all of it. And, I mean, you know, the extrapolation of it is, and it's certainly not what you look at, but, you know, the Fed watching, you know, the thousands and thousands of investors are trying to second-guess the Fed. And I said, look, what competitive advantage do I have in that? I have nil. I would much rather put my money on stuff where I think I have a competitive advantage against other people in working out that this company is attractive or this one. And that's what I wanted to invest in.
Hi. Ian Fraser here. I think it was 2003, you were nicknamed the Quiet Assassin. I'm not sure who by.
Right.
But apparently it was for the way in which you maneuvered behind the scenes to ensure that Michael Green did not become chairman of the enlarged ITV. Were there other instances where you maneuvered behind the scenes to ensure that someone lost their job or else was not appointed to the job which they were supposed to be appointed to?
And can I, what would make you go active?
Okay, let me talk about that, because this is interesting. So, one of the things, as my funds started to get bigger, as we've touched on, there are a lot of disadvantages of running very large funds. There are some advantages, and it got me more interested in becoming more active as an investor, because I thought if we could help make change for the better and improve, you know, the companies that we were invested in, then that was going to help us, and it was something that we would have more influence than someone running a small fund would have. We nearly always did it behind closed doors. I'm totally convinced that the most productive, you know, discussions with companies when you're trying to influence them on what they should do, and normally it was about the management or it was about strategy. The best conversations you have are behind closed doors. Sadly, ITV got into the public domain. I think partly because it was media companies that we were in debate about. And so to answer your question, yes, there was quite a lot of that we were doing. But if you do want to do that, my observation was it's very time consuming, and it also locks you into the company for a while, quite a period of time, which might be fine, and often with me that's fine, because of my holding periods was normally in years, rather than months. But I remember there was a particular company where we really thought that the CEO was not up to the job. And we thought, well, how can we change things? And what we managed to change the chair of that company. We thought, well, if we change the chair, then they can look at the board and change it. So the new chair came in, and he said, well, I'm not sure if I agree with you. I need some time to work out whether you're right or wrong. And we said, oh, fine. Well, a year later, he comes back and he says, well, you were right. We've got to change the CEO. So it can be a very long process, I'm trying to say. But I think it can be productive.
I'm Robert Steiner. Thanks for your presentation. As a Fidelity customer, it's appreciated to put a face in front of the business. I'm wondering if you could compare and contrast your role as an investment advisor or fund manager versus the CEOs and senior executives of the companies you're investing in or not investing in. I think it was partially addressed by the previous question, but there's a difference in stock price valuation versus making money with the assets that the companies has. I'm wondering if you could comment on that.
I'm not sure if I 100% understand the question, to be honest, but you're saying there's a difference, obviously, between running a company and producing a stream of profits to what we do as an investment manager.
That's my assertion. It might be wrong, but that's you.
No, 100%. I mean,
your business is in investing for the basis of your customers to make a profit on the stocks, versus the CEO's job is to maximize the investment of their investors / the business. And there is a difference, in my opinion. I could be wrong, but I'm just wondering what you think.
Yeah, no, I agree with you that there is a difference. They're different activities, yeah, and require a different type of person to be successful in each.
Thanks for your time today. There's a lot of discussion about the state of the UK listed markets, and I don't know how close you are to the policy discussions around that, but the sort of disinvestment by the corporate pension funds over the years, somewhat on your watch, sort of de-risking of the corporate pensions in the UK away from equities. The suggestions almost mandating a certain allocation to the UK equities, which were discussed, luckily not introduced. How do you think of, what is the right answer? Are you any close to or any of those conversations given your history?
Okay. Can you just...
So is the corporate pension funds, should they invest
it's not specifically on that. It's just more of a sort of, how do you fix a somewhat dysfunctional UK listed market today?
So you're now talking about the catalysts. As is well known, the pension funds and insurance companies have one of the lowest allocations to the domestic market relative to anywhere else. As you'll see, the government said, we'd like this to change. They haven't mandated anything. I think if it doesn't change, they probably will, rightly or wrongly. I mean, that's very debatable whether it's something they should be doing or not. I think it looks to me as that they probably will. will this make a big difference? It'll make some difference, but you know, obviously, a lot of that sort of pension fund money has moved away from equities, you know, to de-risk, has been de-risked. I mean, whether that's a good thing or a bad thing is a different conversation, but that those sort of funds probably will never come back into the equity market. But it seems to me, you know, that in many other countries, the domestic funds tend to have about 20% of their money in their domestic market. Why the UK's got down to 4 seems strange. Now, look, if I'm right about the future and something big is going to change in the world with a view about America and index funds and stuff, that's going to be a catalyst to change very much how people think about investing. So I think that's probably going to be a catalyst that that's going to be the catalyst that changes the role of the UK.
So listen, we're going to...
Well, can I ask a quick question? One of the great perks is because I've got the mic. Can I do that very quickly?
Yeah, of course.
Very, very quickly, Anthony. You said that you're contrarian and unfashionable. In order to be unfashionable, you've got to have a sense of fashion and to know what the way herds and people act. Do you think that you have a particularly good sense of herd mentality? And is that key to your success?
Yes, but but herd mentality, you've got to measure. So you've got to measure popularity. You've got to measure, you know, over ownership. All the sort of sentiment indicators that people look at. That's what I think. I think an investor who doesn't look at those is really missing something quite important. You know, short interest is something I'd look at. Insider buying. I mean, it's interesting. In America, you've got record insider selling of the American market. I think that's an important indicator to me. So, yeah, you definitely look at the stuff. Put call ratios, all that sort of stuff, which indicates sentiment and popularity. Okay.
So, listen, when I announced this event, one of my clients, who is a former Fidelity PM, wrote an email to me.
Oh.
He said, I noticed that you had Anthony coming on to the podcast in a couple of weeks' time. I was incredibly fortunate to have worked closely with Anthony when I joined Fidelity and then to have had him as a mentor when I began managing portfolios. He has an exceptional mind, a natural, insatiable curiosity for stocks, and is quite simply the bravest fund manager that I've ever met. More than that, he's a wonderfully kind, courteous, and generous individual, and I can't thank him enough for the advice and wisdom that he shared with the investment team. And I'd like to thank you for sharing that wisdom with us this evening. It's been really fun. Thank you.
Okay.
So I get to say the good bit. Please join us for drinks, sponsored as ever by Kennox Asset Management. And thank you all for coming, and particularly for Anthony and Steve for coming all the way from London. Thank you.
Sorry, I just have to ask a question. I took this chat.
Sorry I arrived so late.
Alex, hi. How are you?
You're far too bloody modest. If I'd been given the chance,